Welcome everyone to today's short video where I am going to basically go through a mathematical example of a fictional company and show why the rate of growth is very important, possibly even more important than the growth itself of a company. So let's get right to it. So let's say we have a company grow, whether that it's its ticker or its name, it doesn't matter because I just made it up. Um, and now let's say it's growing earnings at a compound annual growth rate of 20%. And this year it has earned $1. Well, what this means is that the market thinks next year it'll earn $1.20 and to compound that at 20%. So in the next year, 144, then 172.8, and so on and so forth. Now, what's very important is this is what the market thinks that the company is going to do. And so it gets priced in. So with the company compounding earnings at 20%, in year 5 it will earn 248, and year 10 it will earn about $6.19, and year 15 it might earn $15.40 if it can keep up its current growth rate. So let's say grow were to be worth 10 times what it will earn in 10 years. Well, then, even though it has $1 of earnings today, one could argue that it would be worth $61.90 today, based on the fact that it is its growth rate of 20% is being priced in. Well, guess what? The market can see that it's growing at 20%, and that information, just like any other metric, gets priced in. But now the company has amazing expectations. 20% growth, that's stellar. But what happens if it misses by just 2%? What happens if it's growing at 18%, which is still very good, and I'd love to have companies that are growing at 18%. But let's look at what happens 10 years down the road. Instead of $6.19, they're now projected to earn $5.23 if they can keep compounding at 18%. Now, even though that's just 2% off of the 20%, the stock is now worth 15% less in 10 years by the same metric. Well, so what? You may be thinking, okay, so you have a company that's growing year over year 20%, which is stellar, and then all of a sudden it grows 18%. And you're thinking, well, that's still solid growth. The company should be, the share price should be growing in value. Except when you look at it a different way, the projection of 10 years out, and that's what the market does, it prices in future cash flow. All of a sudden your stock is worth less than 85% of what people thought it would be worth just before they released solid earnings. This works the other way too, because you see, if the company goes from growing at 20% to 22%, then 10 years out, its earnings would be $7.30, and that would increase its value by almost 18%. My point is basically just that growth is like any other valuation metric, and it gets incorporated into the stock price at whatever assumed rate the market wants to assume. And it can get discounted or whatever based on the chances that the market thinks that it will continue, but the market knows. And even if the cycle continues after the peak growth rate, it's just slower and slower, the stock price of the company that was growing very, very quickly and then slower and slower, but still growing, their share price may have already peaked. In conclusion, small changes to assumptions in the near term get exaggerated out over time. And this is why the rate of change of growth is very impactful in determining the stock price and not just if it's growing and the speed it's growing. As always, everyone, thanks for watching. Curious to know if you knew this, if you didn't, or if you think it's incorrect or whatever. I'm also interested in knowing if you want to know more or want to see me do more videos like this where I talk about some specific topic, or if you want me to talk about specific stocks or what. Just I have tons of ideas of things that I could be doing, but only limited amount of time to work on what I actually do. So let me know and I'll steer my time accordingly. Until then, have a great day.